Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's August 23rd, 2019, episode 42, featuring our summer special edition. This is Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. We have a different format for these last 2 weeks of summer. We start this week with an update from our good friend Kuppy, where he's going to talk Scorpio Tankers and Greece. We will then take you on a blast from the past, playing some fan favorite clips from past shows.
All right, let's just jump right into it then. Lena, join us here. What's the featured beer of sponsor for this week?
This week, we're sponsored by Silversmith Brewing Company's Bavarian Breakfast Wheat Beer.
And actually, wait, before we do any more, this is again the same sponsor as last week. And I got into a little bit of trouble because I enjoyed the beers a little too much, didn't I?
Just a little bit.
Yeah, just a little bit. Also, I broke my cardinal rule of starting at lunch and then recording at 4. So I won't be so sloppy I won't be as sloppy this week, folks. I'll keep it tighter. So,
all right.
Sorry, Lena. I'll let you continue.
Yeah.
Okay, so this classic Hefeweizen is light golden and perfectly hazy with a tall, persistent head, aromas of bananas and clove, and a fresh, citrusy finish.
All right, let's try it.
I don't know. Bananas scare me, but let's give it a whirl.
Is this supposed to be beer you drink at breakfast? Is that why I call it
breakfast? I think it is. It's a breakfast beer.
It's not bad.
Actually, it's pretty good.
Yeah, I'm okay with this for sure. This is good. I'm going to enjoy this. This will be a good episode.
This is like a segue to a sour.
Well, I wouldn't go that far. Anyways, a big thank you to Andy, who was our sponsor for the past 2 weeks and gave us both of these great beers. So really appreciate it, and right. I will make sure I keep it tight.
Kev, disclaimer quickly.
Oh yeah, clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include FOMC sleep disorder, jungle theta decay, and or covered call chlamydia. I think, Patrick, right. You've had that.
I've had that. Okay. All right, let's get on to our featured interview.
Okay, at this point, it's our pleasure to welcome back to the show Harris Kupperman, who's a famed hedge fund manager and also the author of the famous blog Adventures in Capitalism. Thanks for joining us today, Harris.
Thanks for having me on.
Yeah, and actually, while we're talking about this, we are pleased to announce that Harris has agreed to come on the show every month. We're going to have him on the last Friday of every month, and we're going to have the Kuppy's Corner.
Nice.
Yeah, I'm excited.
Yeah, no, it's going to be a lot of fun. So for those who, Harris, what you don't realize is that we went out and we had one of those Market Huddle meetups, and everyone asked who some of their favorite guests were, and you were high on the list. And so it's a pleasure to have you every month. And let's get to it. What are you thinking about this month? What's on your mind?
All right. No, I'm super happy to go join you guys once a month. Maybe one of these times we'll actually do it in person. Nice. What's on my mind? Shipping. I wrote about it this morning. It's been an 11-year bear market. We talked about it a few months ago. I said you had to go buy shipping. I said particularly Scorpio. At the time, stock was in the teens. Now we're in mid-20s. And I think the sector's about to really inflect. You've had this whole thing where this trade war talk is dampening share prices. Everyone's looking at shipping and saying, well, isn't that global trade? And I think people have lost the narrative here. When you have geopolitical volatility, what happens is that existing trade routes get disrupted. There's only so many vessels in the world, and if they have to go to different ports than they're used to, then they're going to go further. It's actually adding ton miles to global trade at a time when IMO 2020, which is going to mandate low sulfur fuel, is going to restrict the global fleet because a lot of older vessels need to be retired. So you have these two catalysts at the same time. And, as I said in my blog post, if you had told me that we were going to have a big trade war, I would tell you that the price of a container vessel from China to Long Beach would probably go down, right? Because global trade is down, and I just pulled this up a couple hours ago just for this talk. But if you look at containers, okay, in year to date, inbound containers are down 4.8% to Long Beach.
Right.
And it's accelerating each month. The month of July, it was down 9.9%. So volume's going down rapidly. You'd think that container vessels would see their charter rates drop. Instead, it's the opposite. Charter rates are 7-year highs. And
So is that-
what's cost? It's IMO.
Right. Okay. And so, Kuppy, is that the Baltic Dry Index? I'm sorry to interrupt there, but is that the Baltic Dry? Is that what we're looking at as charter rates when we see that?
That's the index of dry bulk. That's also making multi-year highs. Basically, they're all making multi-year highs because ever since this bear market started, there's been a pullback in ordering, especially starting in 2016. You've seen an increase in scrapping, and now with the trade war, you're seeing ton miles expand. And between that and a lot of downtime for installing scrubbers, you've had a situation where supply is contracting at a time when demand is increasing. And you're getting charter rates increase. And this is across the entire shipping sector. Everything from LPG vessels to LNG, which hit an all-time high last year, to clean tankers, which hit a multi-year high this spring. Basically, all the sectors of the global fleet are seeing recovery. And the amazing thing is that this recovery is happening and share prices are 10, 20% off all-time lows. The whole world's missed it. And when something really good is happening and no one's paying attention, you have an opportunity to make a lot of money. And that's why I wanted to bring it to my own readers' attention, because something really good is happening in shipping.
And so you mentioned Sting before, that was one of your picks, STNG. Why don't you talk specifically about that stock and why you like that one?
So Sting is a play on clean tankers. Clean tankers, they transport refined product. And so what you have this situation called IMO 2020, which mandates that all shipping companies going forward either have to use low sulfur fuel, which is really just a blend of different fuels. There's no such thing as low sulfur fuel. Or they have to install scrubbers, and they can burn much cheaper high sulfur fuel. And so on Jan 1, most of the global fleet will not have their scrubbers installed yet, and you're going to see a huge increase in demand for low sulfur fuels to be transported around the globe. And that should massively increase the demand for Scorpio's vessels. They have the largest clean tanker fleet globally. It's one of the youngest fleets. They're going to have a large percentage of their fleet equipped with scrubbers, gives them a huge cost advantage when they go out to charter. And when you see demand for vessels increase, and I've seen estimates anywhere from 5 to 15% increase in vessels, it should do some pretty phenomenal things for charter rates. And Scorpio is a stock that's down, 99%, 90% or something over the last 5-6 years through the bear market. There's a lot of recovery here. And even if I'm wrong, you're buying in at about 2/3 of book value. You don't have to be very right to make some money here. And there's a potential you could be very right.
What do you think the market is so focused on the negative? Why are they missing it? I always kind of try to understand the other side of the trade and walk me through why they might be overlooking this sector.
Because everyone's talking about trade wars. I mean, what is a shipping company except trade? People are looking at this as a direct, negative of global trade. And I'm saying that no, when you have a trade war, it's usually pretty good for shipping stocks. But people just aren't thinking about it right. I think that's the main issue.
So Kuppy, how about the other shippers, like a Diana Shipping? Are you bullish more broadly, or is it really the one company specific that you're focused on?
I'm bullish broadly. I own a basket of shipping names. Scorpio is by far my largest position, but I own names in most of the subsegments, except for containers. I think good things are going to happen all throughout the shipping universe.
Right.
I'd rather not name any other specific names, but
no problem.
I think good things are going to happen to everyone.
All right, so let's move on and talk about Greece a little bit, because it was interesting because we had you on and you're like it may be a little overdone and you're looking for a pullback. Is this a good enough pullback to buy the dip on in Greece?
Yeah, I bought some last week. The New Democracy that won the election, you had an immediate sell the news reaction. That's, I guess, expected. You then had Argentina do a -50, and all the rest of EM sold off, and the rest of the world sold off. And, you had a chance last week to buy Greece, pretty much the price it was at, the Greek ETF, pretty much the price it was at the day after they announced the elections coming up. And so now you actually know New Democracy is in place. And you were able to buy it at the price where I was first on 6-8 weeks ago. Look, they Greeks just announced their treasury numbers this for July. Tax revenue is up 8%. Think about that. It's a country where these people are known for not paying taxes. Tax revenue is up 8%. It tells you that things are going pretty well. The new prime minister, he's focused on his tax relief program. He's focused on privatizations. He's kind of going to war with the rest of the Eurozone and saying, these mandated surpluses are dumb. The handcuffs you put us in are just making the problem worse. And the interesting thing is that the rest of the Eurozone, where a decade ago they were all mad at Greece, they're kind of letting him go forward. And I think it's a good litmus test for what's going to happen in the rest of the Eurozone. Because look at it. They took rates to what, -25, -50, depends which country you're looking at. Does going from -50 to -75 going to make anything better? It's probably just going to bankrupt the banking sector and not stimulate anything. What you really need is fiscal stimulus. They've taken monetary stimulus as far as it possibly can go. And so...
Yeah.
And
you're preaching to the converted, Kuppy, with that. Like, hallelujah. Do you think they're going to figure it out, though? Like, do you think we're there? Do you think the Germans are finally going to pull out those, old bills from their wallet and spend a few?
I think so. They have to. Look, you have Greece trying to run a budget surplus when it's running at, over 100% debt to GDP. It's impossible. They'll never be able to pay it all off. It'll take them, 200 years to pay off their debt? It's impossible. They have to outgrow it. And I think everyone else is going to realize the same thing. And I think it's an interesting litmus test because the concern really was that the Germans would say, no, you can't do this. You can't roll back these mandated austerity reforms. And he's kind of picking away at the edges. And the Germans aren't really saying anything. They're kind of like, okay. And, it does great things for confidence when you have your leader out there saying, look, we're going to grow this economy. And that's why tax revenue is up 8%. And I think this is a great blip to buy, and I bought some more.
Okay, so you talked about something that's cheap. How about something that's expensive? I see in your blog you're talking about WeWork. I have just been going through and reading about the shenanigans that this guy, the CEO, is doing, and it just boggles my mind. I am just flabbergasted. I don't know about you. Like, what are you thinking when you read about him licensing back the trademark "we" to the company for $6 million?
I guess I take a different view of this. If he was able to get SoftBank to agree to it, then great, good on him. I think it shows that SoftBank is so focused on their Ponzi schemes that they'll pretty much let anyone loot them at this point. We're calling it a Masayoshi scheme, where basically you have a private entity and you just mark it up. And then you tell your bankers, look, here's the sum of the parts valuation. We're at a discount to the sum of the parts. And then you mark it up again. And he's been doing this for a while. He's kind of gotten away with it. And it's the moment of truth. He has to actually IPO this thing. I got a hunch that they won't even get the deal closed.
Really?
Look at all the bad.
I agree. Yeah, I agree with Kuppy. There's not a chance. This thing is the poster child of the excesses of the private market.
Well, look at the Ubers and the Lyfts. All these things broke pricing. Like, if you bought some Beyond Meat, you're down a third this month. Like, as soon as they unlock and little bit of stock free, and you get to see where the actual marks are on these things, as opposed to the really restricted float they do for the IPO, you get to see that the public markets don't value this stuff anywhere near what the private markets do, and the private markets are mainly SoftBank just building a Ponzi scheme. I think it's the ultimate choice.
Do you think they're that big? Like, do you think that they're the driving force behind this?
Well, yeah. Look, it used to be like Google will overpay or Facebook will overpay, and then the Japanese are like, "Hey, wait a second, you want us to overpay? Oh boy!" And I mean, because they just call up, was it Adam Newman is like, "So what price do you want to do the next round at?" And he's like, "I don't know." And SoftBank's like, "Hey, let's just make up a number." It's not even a negotiated thing. When you need billions of capital, usually SoftBank, who's putting most of the money up, should be able to negotiate very attractive terms themselves. Preferential terms, preferential voting. They shouldn't be doing, should be preferred equity. I don't know how you structure these things. I'm not a PE guy, but I just find it amazing that they don't even have enough control of the board of directors that they can't stop the CEO from looting the company they're funding. It just makes no sense. They've literally just abdicated any responsibility for corporate governance.
The WeWork is it's beyond, like, I can't, I'm speechless about it. Like, the more shit you read about that, the more fascinating it is that this guy's getting away with it. Like, as I say, I can't believe he's getting away with it. I think we're going to look back at that, and that's going to be the pets.com of this cycle.
Well, wait a second. We just had a pets.com list. It's called Chewy.
Yeah, but it's just, I don't know. The WeWork is so big, and the abuses seem so flagrant and so obvious and in our face, and nobody seems to care, that it just shocks me, and it makes me worried about the state of the market.
So I was having this conversation. It's kind of an ongoing conversation. A really good friend of mine runs a very large fund, and I mean, we've been talking maybe for 6 months now. Like, the prices are just made up on the screen. Why is something worth more or less? Like, it's like collectively the whole world decided to just be stupid, and it's carried on for 3 years. And I mean, you look at some of the things that have managed to IPO themselves that aren't particularly disruptive. It's the joke, like, why is Peloton considered a disruptive company? It's not a disruptive company. They make bicycles. It's a stationary bike. I have one of those. It's like 30 years old. It's not as nice as a Peloton, but
you don't have an iPad strapped to the top of it.
Yeah, I mean, why is that worth $5 billion? Why is Bowflex? They make the same product. Well, why is that worth $30 million? It just doesn't make sense. Why is one disruptive? Why is another one not disruptive? You have like Love Shack. They make beanbag chairs. Like, I had one of those in college. It smelled like piss. It served its job. Like, I don't see what you've disrupted for a $2,000 beanbag chair. I don't understand why it's a disruptive company. Like, I could just keep going on. Like, there's this company called RealReal. It's effective. My mom did this business. She went and picked up handbags secondhand and sold them on eBay. She did this in like 1998. We still have some in the basement she couldn't sell. Like, that's their business model. RealReal competes with eBay that does the same thing. The difference is that they'll send someone to your house to pick up the handbag. Like, there's no economies of scale to this because you have to send a bunch of soccer moms to people's house to pick up handbags. Like, some of this stuff that's IPO'd, Chewy. Like, let's go back to pets.com, okay? People laugh at it because you remember the sock puppet, and they spent a few $100 million on advertising, but I mean, I don't think it got to $1 billion market cap. Like, some of these things are so much bigger this time. Like, what's Chewy right now? Chewy's $12 billion market cap. Like, just in orders of magnitude as to how ridiculous this bubble is. And
so,
I don't get it.
I thought you said Love Shack, like the B-52 song.
No,
I had to Google it, and I realized it's Love Sack, and I never heard of this. So you can have a $1,300 beanbag shown in Eskimo swirl fur, and it's $1,300 so you can lie in this thing. Do people really buy this shit? Like, is this real? Like,
yeah, and it's disruptive though, Kev. It's
disruptive.
But the best part, but look, do a word search of the word disruptive in the 10K. Like, you'll just amaze yourself. Some of this stuff.
No, that's just using the catchwords though, right? Like, that's what sells an IPO is you got to use these catchwords that everyone looks for in order to give it that valuation, right?
The best part about this, there's 48-month promotional financing for your Love Sack.
I mean, this thing made it to what, 500-600 million market cap not so long
ago.
Ago.
This thing trades? Oh, I didn't even know this thing trades. Let's look at this. Love Sack. There it is.
Squeeze.
Oh, it's got a good handle though. It's called Love. Good symbol. You got to give the guy a good symbol.
But they sell a $2,000 beanbag and they lose money at it. I don't even know how that's possible.
Yeah, I'm looking here. It IPO'd at around 20. It ran to 45. It's back down to 17 now that the hold has come off the stock, I assume.
And that's what I'm saying. As soon as these things unlock and you get to a real world price, as opposed to the restricted float, these things reprice quite rapidly. I mean, look at Lyft today. It's down $1. It's pretty much been down every day since the IPO. Like I the people who buy this stuff keep losing money, and I think you're going to run out of bag holders. So when they queue up the what's the WeWork or We or whatever they call themselves this week?
Yeah.
I have to think that some of these bag holders are going to say, "Hey, wait a second, I've lost money on 10 in a row," and you're just not going to see the demand needed to take this thing off SoftBank's hands anywhere near where they've marked it. And so you're either going to have a WeWork collapse or SoftBank or both. If they can't price this deal at all, I mean, he's already going with Plan B and trying to raid the retirement savings of his own employees. Like
what I think is amazing, Harris, is that you have situations where these things are trading at these astronomical valuations, and then meanwhile they're giving away good stocks like your Scorpio Tankers and other things that just happen to not be in the index and not be disruptive. And I'm hopeful that we're going to get a return of the value names, and we're going to start to see those kind of stocks and see stock pickers once again actually be able to add value by picking out names that aren't just overpriced pieces of momentum.
So I'm going to ask you, Kuppy, does this not send the signal to you that this is just like 1999 all over again with that flavor? Like the fact that we're talking about how many stupid, absurd things are going on, does that not make you worried that we're at a late stage of some sort of bubble in this segment of the market?
Oh, absolutely. I mean, it's a total bubble. The entire stock market's a bubble. And I mean, the stock market in comparison to what the long bond's doing, seems conservative. The whole thing, it's just like a global bubble in every asset class known to man, except for, a few things like commodities.
Yeah.
Okay, well, there we go. So listen, for those who want to learn more about what you do and how you write, Kuppy, where do they find you?
Adventures in Capitalism is where I write, and you can sign up for updates, and I promise not to spam you too often.
Too often. I like that.
Yeah, too often. And for those who want to, make sure you stick around. Every last Friday of the month going forward is going to be Kuppy's Corner, and we're going to get more of these great insights and learn more about the love sacks of the world.
Yeah, hopefully.
Thanks for joining us, Harris.
Thanks a lot. All right, what a great interview we just had with Harris. So let's move on. So we're going to, for the summer special, we're going to just start hitting some of our favorite clips that we did. Coincidentally, so many of these clips fell in the spring of, it's not fell, but all came about in the spring of 2019. But so the first thing we just wanted to circle back to was when we talked about Charlie McElligot's gamma charts. It was on episode 28 on May 16th of 2019. And the reason it's relevant is we just came off of a big gamma roll-off on the August 16th expiration. But there will be a huge gamma roll-off coming up on the quadruple witching coming up on in September. And so it's really, I think, important to see what the influences that dealers have with this gamma, right, Kev?
We could have some fireworks for sure.
Right. And so anyway, it's a great little flashback. So why don't we go and everyone enjoy this and stick around right afterwards. We'll get to the next clip. So Lena, why don't you roll this clip for us? So Kev, it's time for a Market Huddle exclusive, right? Charlie McElligot's been getting all of this press with his quant analysis, and there's one particular chart that he shares that it's looking at option gamma. And now many of our listeners would benefit immensely from a primer on how to interpret these charts. And I can't think of a better guy to do it than you, because you used to be a dealer and had to deal with these types of exposures that he's talking about. And so you put together some cool slides to kind of talk about how these delta and gamma exposures work. And so let's dive into it.
Okay, let's do it. And for those that are kind of worried that we're going to talk about all sorts of Greeks and it's going to get messy and ugly,
It is.
Yeah. No, we're going to try to do this in a way that explains, and you're going to come out of it hopefully with the saying, I understand what Charlie's talking about. And so let's start with his chart that is kind of what's on everybody's lips. It's this, this chart where he says SPX and SPY combined gamma per 1% move in spot. And what he has is kind of various line graphs, and it shows that as the strike moves up, the gamma goes from positive, means from 0 to positive, and as the spot moves down, the gamma moves from 0 to negative. And it's just kind of a lot of people, and there's a lot of people that have kind of asked me for my advice about, like, what does he mean by this? Like, what is it? What is he talking about? And I thought it would be really helpful for us to go through how these positions are created and what they mean for the market, so that you can understand when Charlie goes and says, I think the selling is going to accelerate from here, or I think the selling is going to be capped, or you understand why that's happening. So
Kev,
go ahead,
isn't
Patrick.
it interesting, before we go to the next chart, isn't it interesting that the crisscross point from going negative to positive lies more or less around this kind of 28.75 level? And as we're going into Friday's monthly option expiration, where the huge amount of options and gamma exposure are rolling off, wouldn't it be interesting if that acts like a magnet for pinning prices there into the Friday close?
Well, that happens for sure. I've seen numerous academic studies that show that that often if a security is around a strike price with a lot of open interest, it is natural for that to occur, because as people sell it or roll the option, the dealers that are on the other side buy it, and then they basically, it ends up being that, we should really talk about how hedging from a dealer perspective works, because then you would understand why it ends up getting kind of pinned to those levels. So let's go through it.
So we'll go through it. It'll be just an interesting note to see whether a Friday close happens, give or take, near that 28.75 level going into the weekend. So anyway, what's going on here, Ken?
Okay, so let's go to the next slide, Patrick.
Yeah.
So I've kind of made up a scenario for people to understand. And, Patrick is he's the smart one that actually knows how to construct, option positions to take advantage of the market moves. And I was more of a market maker, and I was on the other side of a lot of Patrick's trades, and I just delta hedged them like a monkey. And we kind of put some thought into different strikes and what'll happen in terms of the volatility and around different strikes. But the reality is that we didn't really care as much about constructing portfolios that take advantage of specific market moves. We were more worried about how to maintain a delta neutral book and whether we could make a profitable hedge on that. So what I'm going to do is I'm going to pretend that Patrick comes and he buys. Patrick's a big shooter, and he trades kind of like George Soros size. So he buys 1,000 SPY June 2019, 280 strike puts from me.
Okay, so we're talking the SPY, the S&P 500,
right?
1,000 contracts at 280, and so I come in there. We're we're talking about 100,000 shares, right?
That's right. So it's a big position. Like that's an institutional size order. In my day on the desk, that's 1,000 lot was kind of the traditional institutional size order. So Patrick, he just tosses around 1,000 lots like they're nobody's business. So we thought we'd just kind of deal with that. So at this point, the SPY is trading at 288. Okay. So to hedge my short put position, because Patrick's bought it, I've sold it to him, I have to delta hedge. So I go put it into my model and I figure out the delta. And the delta is minus 29.72 at $288 on the SPY. Now, at this point, some people, Patrick says, well, when he does his models, he talks about the delta as 0.2972, not 29.72.
Well, that's the way it's quoted on most Greek
commission. On the Bloomberg, it's quoted as 29.72. It doesn't matter. It's basically 0.2972. the question is whether your delta goes to 1 or whether it goes to 100. But it's the same. It's the same idea.
It's the same.
Okay?
So just to add and clarify for our listeners, that the delta is telling you the rate of which a option is behaving like the stock. And so a 29-cent delta on a stock means that if a stock rises $1, the option will move about 29 cents. It's telling you the rate of which the option is participating like the stock. Is that a good description, Kev?
It's bang on. For small localized movements, it's the change in the option price versus the underlying.
Right. Right.
Okay, so I go and I short because it's the delta is 29.72. I go short 29,729 spies at 288. Okay, so now I've gone and
you're delta neutral now.
I'm delta neutral. Okay, so I'm immunized from small movements in the SPY. So if it goes to 287 and 3/4, it's and back to 288 and 1/4, I'm going to be okay for the most part. Okay, now let's go on to the next slide, Patrick. Okay, so unfortunately, Patrick is right, and the market starts plunging. Okay. So I wake up, and next thing I know, the SPY has moved down from 288, and it's gapped down to 284. And I know that the option aficionados in the crowd are going to say, but you could hedge it on the way down. But let's just assume that we're hedging kind of in these finite periods just to make it easy to understand. Okay, so it opens at 284, and I check my model. The delta on the puts I am short has now gone up. So now my delta is 37.28. So now if I go figure out my net, yeah, sorry,
so
go ahead,
just to
Patrick.
stop here, because you have in brackets the gamma kicking in. And so let's just clarify to our listeners that gamma is a derivative of the delta. And so the gamma is telling you the rate of which the delta is changing.
That is correct. So my delta is going... It's increasing or it's going down because of the reality is, or sorry, my delta is getting larger because it's going down.
Right.
So anyway, let's just go.
Now,
sorry, go ahead.
Yeah, no, sorry. I just want to clarify. Just one other thing that when a lot of people hear Charlie talking about this, one of the big exposures is going into an expiry, and the reason that is the shorter dated options have larger gammas.
That's
and
correct.
So as an option is getting closer and closer to expiration, the dealer has much bigger gamma risks.
Okay. So Patrick, you're going too far, too fast for everyone.
Okay.
Let's we'll get there in a bit. Let's just go through this process so people understand how the gamma works and how the delta hedging works, so that we can talk about the effects. Okay. So let's go back. So my delta is now 37.28. My negative 37.28. So I figure out my net delta. I'm short 1,000 puts at 37.28, which means that my exposure is long 37,280 spies. But the thing is, I'm only short 29,720. Don't forget, from 288. So that means my net delta is 7,560. So I short another 7,500 at 284. Okay? So now let's go on to the next slide. So another day, and the bears are just relentless, and it's getting worse, and I wake up, and I find the SPY at 280. And Patrick is super bearish, because we know at 280... Patrick is super bearish, and he's getting really upset with the market god. He's tempting the market gods by tweeting all sorts of shit and doing all sorts of crazy stuff. So I look at my model, and my delta is now 54.88, negative 54.88. So I put it in my spreadsheet, and I realize that my net delta is 17,600. So again, I need to go and I need to sell. Okay? I need to go short some more stock. Okay? So I go short and make another sale at $280 on the SPY. Okay. Now I'm all hedged up. Everybody's happy. But then something happens. The next day, Trump announces a trade deal. All of a sudden, the S&P gaps up to open at 296. Let's go through what happens to my position. Next slide, Patrick. Okay. So now... I kind of laugh and say, with a heavy heart, Kevin realizes the gap open will hurt a lot, because my delta on my puts is now gone from minus 55 to minus 22.
Right.
So let's go through it. I'm short 1,000 of the puts to Patrick, and then I'm short 54,000 spies. But the trouble is that I am now basically short 32,000 extra stock because my delta is no longer 54,000. It is now 22,000. So I have to cover 32,000 SPYs at 296. And don't forget, I shorted at 288, 284, and 280. Okay? So I shorted at those levels, and now I'm going back and I'm buying back at 296.
So, Kev, just to clarify to our listeners, one of the things that happens here is that because the dealers have to buy more shares to close out all of their extra shorts, they're contributing to the liquidity that is driving the market even higher. So this is what creates that feedback loop of higher markets beget even higher markets, almost like it's a technical analysis event. But what ends up happening is they provide the liquidity for driving that market even higher.
That's right. So let's go through. So I was short gamma. So therefore, to stay hedged, I had to do the following. On the way down, I had to short more. On the way back up, I had to buy it. Okay? So let's just stop and think about this. The more volatile the asset is, the more I would be forced to buy and sell. So that money that I lose buying and selling is offset by the premium that Patrick paid for his put. So the implied volatility. So at the end of the day, if I sold it to Patrick for, let's say, 25 vol, and then the actual vol ended up being 20 and I hedged it properly, I would make that 5 vol points of spread. If it ended up being 30 or 35, and it's a little more complicated than this, but yeah, I would lose that. So this is the point that you kind of have to understand, is that the dealers, when they are short gamma, it's not that they're short stocks, they're short gamma. They are forced to chase the market. And when they are short gamma is when clients have bought options from them. Generally, clients are buyers of out-of-the-money puts, and then they're generally sellers of out-of-the-money calls to pay for those puts. And so now let's go back to Charlie's. Let's go to the next slide with Charlie's things. And he says, what's with the different gamma at different points? So let's imagine. Let's go to the next slide. Let's imagine that Patrick, because he's bearish, not only bought the puts from me, but he also sold me some 295 calls. Right? Because Patrick, it's not going up. Those are going to be dust.
Oh, yeah. It's an easy way to offset the time premium for sure.
That's right. What better way to pay for your position that you're paying for the puts, right? And
synthetic short.
And this makes a lot of sense for a manager that's long stocks naturally, because that manager will find the portfolio doing well on the way up, and so they might lose a little on the short calls, but then hopefully the portfolio makes money, and then on the way down they're protecting themselves. So this is a very
it's a risk reversal.
Yeah,
it's
So let's go through the idea that Patrick sells me 1,000 of these 295 calls. Okay, and at the 288 when we first did it, the delta would be 27. So I would go and I would short 27,000 shares to hedge my long call position. But the difference is that as the stock market rallied, I would actually be selling more because the call delta would be increasing. So go to the next slide, Patrick. So the key to understanding Charlie's graph is to recognize that dealers who have different gammas at different strikes. And so at the kind of out of the money onto the upside strikes, dealers actually get long gamma. So at that point, they own the calls and they're delta hedging them around, and they hope that the stocks become more volatile. They hope that it kind of goes up and down, and they're going to make all that money by trading it around. But then as stocks decline, the dealers get shorter gamma, so where they are kind of praying that they become less volatile and that they can hedge it properly and that they don't lose too much.
Right.
Okay? So now go to the final slide here, Patrick, or that we go through. But the fact that at the short gamma that there's all these dealers that are actually at the lower strikes, the fact that all these dealers are short gamma actually makes the stocks more volatile because they're the ones that are hedging the positions.
Right.
So, and this is what you were kind of highlighting, Patrick, was the fact that they're contributing to the chasing the market up and selling the market down. And then on the other side, when they're long gamma, they're doing the opposite. They're actually calming down the market, and they're actually selling rips and buying dips. So if we think about Charlie's graph is very important because it shows points at which the dealers will either be making the stock market more volatile or making the stock market less volatile.
Right.
And that's kind of the most important thing to understand is that once we started to go down and once we cruise to the point when the dealers are no longer long gamma, because don't forget, when we were, if we were at 29.20 and then we went down to 2,900, the dealers would actually be buying more stock as it went lower. Because at that point in Charlie's graph, you can see they're still long gamma. So long gamma means that instead of chasing the market, they're buying the dips and selling the rips.
Right.
And then once we go to 20, what was the number? 28.75, they're neutral. So they're no longer the gamma's not moving. And then as it goes lower, all of a sudden they're in a situation where they have to sell the dips and buy back the rips. And that is why Charlie, tries so hard to figure out where the dealer community is short gamma. Because at that point, they're going to be kind of accelerating, the selling.
So that means if the market goes lower, it's a short signal to go even further lower. Is that what you're saying? Almost like a technical?
Yeah. So and that's what Charlie argues is that as we go into that point where the dealers are short gamma, that the selling can accelerate. And
it's almost like technical analysis works.
It's
right?
almost like technical analysis works. That's like you're absolutely right, Patrick. But the thing about it is that you also don't forget that's why you get these rips. Because all those guys that sold down at 28.25 when Patrick was really bearish to hedge their book are now forced to buy this rally, back at 27 or 28.90.
But could you not also then extrapolate? Am I off base in making this point that this is actually a direct relationship as to why the VIX always spikes on the way down and kind of contracts to the bottom end on the way up? Because in general, what happens is the contribution to volatility when they're getting on the downside of the gamma, then they're actually contributing to the volatility, and therefore the implieds will actually widen. Like they're actually exacerbating it.
That is correct. Like if the dealer community gets caught short gamma, then oftentimes it makes the actual volatility of the stock larger.
Yeah. One of the things I've been telling my members in the last 3-4 days is just get used to the fact that a 30-point swing in the S&P in 2 hours is just normal in this environment. This is not, you can't go back to the March and April period where, 10-point ranges is the normal for a day. Like these kind of intraday moves are just actually what's happening here naturally in this environment.
Yeah, except that if we go look at Charlie's graph, and you're assuming we don't go up to 29.25, but up at 29.25, there's going to be lots of dealers with all sorts of gamma to the positive, and they're going to be selling every rip and buying every dip, and that's going to calm the market
I was
down.
talking off the low in the last 4 days, right? So
yeah.
But you're absolutely right. Like once we get up to north of 2,900, the market will calm right down.
Right, and to the extent that you're bearish, if we go back down to 28.50, all of a sudden you could be right that all these dealers are going to exacerbate the volatility and they're going to be hedging again. So don't forget, they're the ones that they sold 28.25s, 2800s, and now they're going to be buying 28.75s. Now listen. The true option people that understand how this works are going to tell me that they don't hedge like as little as I put in my graph, and that it's much more complicated. I completely agree. I understand. I tried to make it simple so that I showed people the forces at work. And Patrick, you were the first one to mention that there's a lot of these guys have thousands of lines of this, and they're aggregating all their different positions into one, and they're trying to figure it out. And the important thing to realize is that Charlie is looking at this, and he's also making some assumptions, and I don't know exactly how he's doing this. He's making some assumptions that the dealers are on the other side of all these trades. And if we stop to think for a second and say, what if instead of somebody comes and, Patrick, you want to trade a big position and you want to trade, 50,000 of these things. And Kevin, I'm too much of an odd lotter. I can't fill your order. So I go, and what happens is you figure out and you get PIMCO or Warren Buffett to sell it to you. Well, the reality is that they're not going to delta hedge. So it's going to behave much different. All the things that we talked about aren't going to exist because the only
they're taking
reason
the exposure.
that they're taking the exposure, and as it goes lower, they are more than willing to be longer in terms of their net delta. But the reason that this does exist is because dealers are on the other side of a lot of these trades, and they are trying to hedge it for every single point. Right. And they're not willing to sit there and go at 2,800, say, you know what, I think it's going to go back to 2,900, or I'm happy being long this. No, they're hedging every single kind of, delta that they have. Some people hedge every, X percent move. Other people hedge every hour. It's all sorts of different ways that you can go about hedging, but they're all doing the same thing. The fact is, if they are short gamma, they are selling it as it goes down, and they are buying it back as it goes up. And if they are long gamma, they are selling it as it goes up and buying it back as it goes down. And that's the important thing to realize. That is why when Charlie's graphs show the gamma of I guess his best guess at the gamma of the dealer community, it helps in terms of deciding whether we're going to get kind of a runaway move in the stock market at specific spots.
All right. Well, Kev, thanks for the explanation. I think that's all of our listeners appreciate you taking a stab at this, and hopefully there adds clarity as to how some of the dynamics behind liquidity that happens in these market cycles.
Okay, for Tales from the Trading Desk, we go back to episode 17. Steve Sosnick from Interactive Brokers with one of the ones that just had Patrick and I in just rolling on the floor with laughter. It was Calling in Fat from March 1st, 2019.
As we wanted to get out of you Tales from the Trading Desk. And you obviously have been in this business for a while, and I have to think that you got a pretty good story to share with us. So tell us a great story.
Well, I was trying to think back. There's a lot of them, but I'm reminded basically in 1990. So this was when we bounced off of the crash, but there was sort of like an echo, let's say, after the Fed eased. And at that point, I don't even remember at that point. Was it Shearson, Lehman, Hutton, American Express? I kept getting new business cards, on sort of an every 6 month basis because we would change the name of the firm. And it was a fascinating place to be because it was the different merged elements hated each other. And so the equity, the listed desk and the over-the-counter desk would not speak to each other. They were mortal enemies. And I was hired with a team. I started my career at Solomon Brothers, and they hired us. They gave us a lot of money at the time, I guess, not as much as everybody thought we were getting, but that was part of the problem. And they hired the foreign equity department from Solomon Brothers, which I was a part of. And we, by the nature of that business, ADRs trade on all exchanges. So we would trade listed and over-the-counter stocks. So everybody hated us. And I refer to the over-the-counter department as one of the great original over-the-counter crime families. And that's really how the NASDAQ was run in those days. It was very much old school guys. It was who you drank with. It was, you get the phone calls. Why the fuck did you tighten the spread, you asshole? Those kind of fun days. I have an order. Well, I don't give a fuck if you have the order. Well, sorry, fuck you. Yeah, just curse back at him. And literally one of the business strategies was from the head of the department was go to as many of these conventions around the country, security traders of Philadelphia. My beat was Montreal and Toronto. Go to these things and try to get in as many pictures in Trader Magazine as you could. This was the business strategy to getting yourself out there. And so, we're one of the things that was in my bailiwick at that point. At that point, there were Nikkei warrants, Nikkei put warrants that traded on the Amex, and one of the knocks on them was they seemed very overpriced. But when the market started to hit the fan a little bit, and these started to get to be, in the money options, I realized this was the way we could more or less hedge the desk. And the head of the over-the-counter department, basically put out the edict one day. I want none of you fuckers to be long more than $250,000 in your books. Okay, fine. I get that. It was actually a good market call because the market the next day basically plunged. But I was long, probably $500,000, probably almost $1 million worth of Nikkei put warrants, which to anybody who understands options and warrants, that means you're actually short. Well, so he comes out the next day, the markets are way down. The nature of that business is you're long inventory, so it's a bad day. And he's going around the room looking at everybody's books. What are you long? He gets in my face. It's like, I thought I told you no one was going to be long more than $250,000. You're long like $1 million. Like, yeah, yes, but I don't want to hear any buts from you. How much are you down? I said, I think I'm up about $100,000 or something right now. It was one of the best days I've ever had. What the fuck? How are you telling me you have some fucking magic product that goes up when the markets go down? And I'm like, yes. What are you doing about it? I'm like, why are you yelling at me? I can't do anything about it. I'll try to trade out of them and then lock in a profit. And he just basically skulked back to his office. And I realized, you know what? You really have to understand your strategy and your products. And later on, that was a hell of a lesson to me. It was like, oh my God, I'm working for a fucking moron. And I did leave. I did leave shortly after that. But basically, the other part of the problem was it was such a dysfunctional place. At one point, the guy who during the steel cage death match between the head of the over-the-counter department and the head of the listed department, the head of the over-the-counter department, the one who I explained about magic products to, won the power struggle. And there was an all-time sales trader. So they were bringing it, they brought one. They then told one of the other guy's deputies, who was in Disney World, that he was going to be running the listed area. So the guy cuts his vacation short, comes back from Disney World. Along the way, they changed their mind and fired, and comes back to think he's taking a promotion. He gets fired too. So there's another old line guy, Victor, and he's walking around going, "Give me an ass to kiss. Just put an ass in my face. I'll kiss it. I don't even know whose ass to kiss. Give me an ass to kiss. Got an ass out there? I'll kiss it." I'm like, holy crap! I got to get the fuck out of here. That was some lunacy back then.
Those days. That's the Wolf of Wall Street days, right? Like that's.
Wolf of Wall Street was actually more recent than that. But that is just awesome, Steve. Like that is hilarious. You know what I think is funny is that people don't realize how often your boss is just completely out of touch, like as a trader. We always used to just cringe when the boss would come and make us tap us out of a position because we would always put it into our PAs at that point because at that point that it's going like their timing is terrible. They don't have a clue what they're doing. They're just reacting. And I just think that is the funniest story ever. Like that is how it used to be. I completely agree with you. It's just was madness.
Yeah. That was a specifically dysfunctional group. The best story actually was involved like a friend of mine who was notoriously, he was this fat, disheveled looking guy. He was a great friend. And for whatever reason, this guy was a ladies' man. And his wife one day, one of my friends was in, I actually had then moved to trading equity-linked products, considering that I understood these magic products. I then became head of that area. And so I was trading these equity-linked products called primes and scores, which were then outlawed by the IRS. And literally the guy who invented them did nothing but sit in his office and tap a globe against the wall, because we called him Globe Guy, because he had this one great idea. The IRS shut it down and eventually took his contract and left. But and so one of the guys, one of the officers comes up and he goes, I let his wife in. I'm like, what the hell do you mean? And it was this, it was a neighbor who worked in the department. Guy's wife is sitting at his desk, going through his drawers and his Rolodex, and nobody's afraid to approach her. I knew her pretty well. I'm like, hi, what are you doing here? And she like reaches into his drawer, pulls out a pair of panties that some woman sent him. So I'm like, oh, this must come in handy. But unfortunately, we had to get her away because she was going through his Rolodex and hitting all the speed dial buttons, like thinking they were mislabeled. It'd be like, oh, I'm gonna hit. This one says Fidelity. I bet you it's some girlfriend. I was like, hello, who is this? It's like, Fidelity. You can't do this. You can't kill our. I don't care what you guys are doing in your home life. You can't kill our business by just hitting every speed dial button and yelling at every woman who answers the phone, because she's probably a buy-side trader that we've been cultivating. Can't do this shit. So those days were they were interesting. Let's put it that way. And coming eventually ending up in a very quiet, quantitative, austere environment definitely took a little bit of a change from coming from the wild world as it was. I mean, I could go on for a while. There was some nutty stuff.
My God, Steve, that's the funniest story I've heard in a long time. But
yeah, no, that's like that was. Really
I don't know if it's the Green Bastard IPA or what.
Yeah, no, it's definitely this is like the Trailer Park Boys quality Green Bastard stuff. I
could just see the guy's wife going through and hitting the lines. Like I could completely picture it in my head. And then you're sitting there cringing as she hits as the clients are picking up, and you're just going, "Oh my God, we got to get her out of here."
We got to get you out. Can't do this. And meanwhile, my friend, the option trader, I'm like, how did you let her in? He goes, she lives down the street. She waited for me in the driveway and hopped in the back seat in the car with me.
She obviously knew her husband really well.
Oh God! You know what? This guy's a legend. I won't mention his name just because it's not fair. He had the best line ever because he again was a great sales trader. His clients loved him. But he was a little cavalier with timing, and apparently he one time was tie one on, get a big order the next day, but occasionally was a little late to work, and was calling in late or sick because he had a little too much fun the night before with his clients. And finally, it's like, all right, if you call in sick one more time after being out with clients, I don't give a shit how many tickets you write, you're fired. So the guy calls in and he goes, I can't come in today. And he goes, you better not tell me you're sick. He goes, nope, I'm not sick. I'm fat. I can't fit in any of my suits. I'm too fat. I can't come in today. And the guy was such a guy that everybody loved. The boss who wanted to fire him just like, yeah, okay. I got to give you that one. So damn. Yeah. No one's ever called in fat before.
I think we just found the title of the episode, Patrick. Calling in fat.
Calling in fat. That's awesome.
Okay, for This Week in History, one of Patrick's favorite segments and one of his favorites.
One of mine. Yeah, you're the one introing it. But anyway, it was one of your favorites too. Come on.
Whose is it not? So we go back to episode 20, the Dutch East India Company. And Never Say Never, March 22nd, 2019.
So, time to move on. And I want to get to what I think is by far one of the most interesting events in This Week in Trading History.
Okay. What is it, Patrick?
Well, it is the United East Indies Company, or known as the Dutch East Indies Company. And it was the first company to ever become a corporation. It was in 1602. By the way, check out this logo. It's the VOC is the acronym for it in Dutch. I like that. That's the first corporate logo ever.
I didn't realize it was the first company to be
First company ever. So let me just go through. I'll tell the story in a second. But here's some of the thing. First a corporation, first IPO, first stock exchange. The first to colonize Cape Town. They're the ones that discovered New Zealand and New Holland, which was later renamed as Australia. Like and the largest corporation on inflation adjusted that ever existed.
Whoa, Australia was called New Holland?
New Holland when it was discovered.
I had no idea,
New
man.
Holland and New Zealand stuck, and New Holland was renamed Australia.
Oh, I didn't know that.
But this is a big deal, and I love this story. The more I researched it, the more I was fascinated by this. So let's kind of go through all of this, right? So it's the Dutch East India Company. It was March 20th, this week in history, in 1602. And so just to put that in perspective, you take where Napoleon was and the Mississippi bubble and all of these, and you have to still go 200 years earlier. So those are like the midpoint. We're going to 1602. And there was a huge and fierce competition in Europe for trade, obviously, and mercantilism and all these different things. And the English formed a cartel, the English East India Company type of thing. That was more of a cartel. It wasn't a publicly traded corporation or anything. And at the same time, the Spanish took away the ports they took over Portugal, and they took away the major trading port in Lisbon away from the Dutch. And so the Dutch were getting squeezed on every end, and the merchants in Amsterdam basically got together, and rather than working independently, they all came together and they created what is the very first corporation that has ever come to existence. And all corporations that we know today were originated from that. And more importantly, they created the shares. And the shares were traded, what became the very first stock exchange to ever exist.
Wow.
So not only was this the first corporation, but then the first IPO then, but it became the first stock exchange to trade that. And just some amazing stories. They obviously had their own military power. They were able to coin their own money. They even had the power to enslave people. It was like the craziest power corporation that existed. But what was crazy about this is at its peak, it had, on an inflation adjusted, a market capitalization of over $8 trillion, which makes it the largest corporation that ever existed still to this day.
It was more than Amazon.
More than Amazon and Apple combined at their peaks, times 4.
Holy smokes. Wow.
Like this is absolutely crazy. So what they were doing, they had to circumvent and they had to create their own trading routes into the East Indies, to India and everywhere else like this. And so in the process of doing so, they were the ones that from Turkey or wherever it was brought tulips back to Amsterdam. And it was 30 years later that on those very stock exchanges that the famous tulip bubbles. I don't want to get into tulip bubbles because I think that in itself is a whole story we've got to cover in This Week in History. But the origins of the tulip bubble all come from not only the East India Company, but the very exchanges that and the stock exchange that came to existence there. Isn't this amazing?
So when we look back at all these crazy IPOs and stuff, we can blame the Dutch East India Company as being the start of it all.
It is, but there's even cooler stories than this. I'm not even done here. So this Isaac Lemery was on that exchange the first person known to on record to be the first short seller to ever come into existence. And in his process of going short, He was first recorded investor to seriously consider corporate governance. In 1609, just 7 years after this company was formed, he petitioned, created, it was the first form of shareholder activism that came into existence. He charged the VOC's board of directors for all of these accusations and petitioned for the liquidation of the VOC in accordance to standard business practice. Like, this is all first stuff that ever happened. Everything we know.
Sounds like a real dick.
He does. But it's just amazing. So first short seller, first shareholder activism, all of this has originated from this. And the company basically went bankrupt in 1799 because of some problems. But what I wanted to just show, here's some pictures here. So they still have in the downtown the original headquarters of the VOC and the Dutch East India Company. And
really?
Yeah, it's still there. And more importantly, when you go and to downtown, in the red light district of downtown,
Nice.
where back in 1800 they had to rip down the original exchange and they rebuilt it, the Boers van Berlage or whatever they call it now. But now it's just a conference center that was rebuilt. But that's the location of the first exchange ever and of where the first shares were ever traded. Of the largest corporation that ever existed. So when all our degenerate listeners are back in Amsterdam the next time in the red light district, make sure you walk by there and enjoy that little piece of history.
Come on, our listeners are much too sophisticated and not at all degenerate enough to go to the red light district.
Well, everyone's a tourist. Everyone's a tourist,
that's
right? But
there you go.
But isn't that a great story?
That's a great story, man. That is awesome.
And you know what? That inspires me. We have to circle back. I got to find some sort of a date we can pin to a week for the tulip bubble. But we have to talk about this because now that we've kind of created this kind of foundation, it's going to be a great story to talk about in our tales.
Sounds great. Well, thanks for sharing that with us.
So, Kev, for a blast from the past, I was thinking long and hard about the WTF clip, and there's so many funny ones, dude. You're a master of this stuff. But one particularly had me laughing so hard, and that was back on episode 18 when you did Kramer versus Kramer, no smell, no tell. And I thought it was spectacular, and I think that if there was one where we should go back and re-listen to and watch again, it was done back on March 7th of 2019. It's when both Kramers were drinking. Let's have a watch on this one. Kev, you put together what I had to watch it 3 times. I was laughing so hard. You put together a fabulous WTF clip of the week. Anything you want to quickly say before we run it, or you just want to run it?
Well, I'm still trying to make back all the kind of the negative hate mail I got from my dark one. I made that one dark one where I went down this road that wasn't as much funny. Well, it was kind of maybe a little bit dark humor. So I'm trying to keep them a little bit more upbeat. And let's see what you think. Let's play it.
My mission is simple, to make you money.
Yeah, so?
He's acting very strangely. I think he started drinking again.
Hey, I'm Kramer. Welcome to Mad Money.
Come on.
Okay, well, what am I drinking? What do you got?
This is ridiculous. Today we got some good news about the trade talks with China. And after initially erupting higher, the averages sold off and then they sold off dramatically. Dow closing down 207 points, S&P sinking 0.39%, NASDAQ losing 0.23%. Although all these indices were down much, much more intraday, particularly the NASDAQ. It was an unsettling reminder that stocks remain fragile and the asset class simply is not capable of handling severe selling all at once, which is the case.
That is damn good scotch. I could do a commercial for this stuff. Boy, that Hennigan goes down smooth. And afterwards, you don't even smell. That's right, folks. I just had 3 shots of Hennigan's and I don't smell.
And therefore, it's almost entirely machine-driven. Why do I think it's machines doing the selling? because the action today had nothing to do with trying to find the right price or the best price. The machines just went out, and they're not price sensitive at all. That's the opposite of what actual humans do when they work orders to get a better than the average price at the end of the day. If it were actual humans doing the selling, they would instruct their brokers to find buyers first. They would walk away if there are none to be found. They'd let the bids build so the stock goes higher without them. And that's not what happened midday. Instead, we had multiple sellers that didn't give a darn about price. They didn't give it a second thought, which is a classic sign that these decisions are being made by algorithms, not by people. So.
Imagine, you can walk around drunk all day. That's Hennigan's. No smell, no tell, scotch.
Look, don't get me wrong. In Friday night's game plan, I very specifically warned you to expect turbulence this week ahead of the jobs data. Remember, that report comes out Friday. I don't object to the fact that we went down today. And a lot of people say, oh, Kramer, you're just a bull. No, I don't mind that we went down one bit. I object to how we went down.
Say you got a big job interview and you're a little nervous? Well, throw back a couple of shots of Hennigan's and you'll be as loose as a goose and ready to roll in no time. And because it's odorless, why, it'll be our little secret.
The speed of vicious velocity that freaks people out and calls into question once again whether this asset class is even worth owning.
The House of Pain.
Can it be trusted? What makes me so certain this selling was mindless? Simple. I don't hear a single, not all day, did I hear a single cogent explanation for the massive, relentless selling
Sell.
that engulfed the averages a little after noon today. Selling the
A-T-double-N-R. Kramer. Yeah, that'll do.
You know what? After drinking half of this extremist beer, I'm feeling pretty loosey-goosey myself here.
And I kind of laughed when I saw Kramer complaining about these algos driving down the market. Can you pull up a long-term chart? Like we just spoke about it in terms of this bull market since that 2009 low or 2009.
You want a weekly chart?
Yeah.
Like you want a big
yeah. So let's look at what Kramer's getting upset about. Look at it. It's this tiny little amount. Like, what is that guy smoking, or I guess what is he drinking? Because the guy he's kind of lost it in my book when he starts complaining about the market going down, not only from a bigger perspective, like in terms of multi-years, but even in terms of a monthly or a weekly perspective. We're 20% off the low, and the thing goes down 2%, and he starts screaming about the machines.
The machine selling. Like, give me a break. Yeah. You know what? Like, the stock market has to go down just as often as it goes up in some degree or another. Now, maybe not equal amount of time, but the market is a self-correcting mechanism all the time, kind of overshooting and then undershooting, and the mean price is sort of in the middle. And this price discovery is happening all the time. And this idea that anybody who is selling that causes the stock to go down is like nonsensical or irrational is almost what I got from him trying to explain. And this is all the algos.
Yeah,
it's just silly.
It's dumb. Like, listen, I'll tell you one thing. I do agree with him that the world has changed in that I believe that portfolio managers make a decision on the day. And then they put in orders that are VWAP or TWAP, meaning that they're averaged out throughout the day. So I think the market has become less responsive to daily news. And I think that also it doesn't matter. If the stock market is down 1%, they keep selling. It's not like the portfolio manager says, I want to sell today, and I'm only going to sell if it's at 1% or higher, down 1% or higher. They just say, I'm going to sell it today. And I've seen this time and time again where it seems to be that the market doesn't react until the next day to the actual news. But this happens on the upside just as much as it happens to the downside. And in fact, if you look at it over the last 10 years, it's happened way more to the upside. So Kramer is just like, this was just ridiculous. I think he embarrassed himself with this kind of talk, and I think he should just go back to drinking his scotch and
Well, you know what? What I'm shocked is it took us till episode 18 for Kramer to make his first appearance on the Huddle.
Is that true? We haven't had him yet. I didn't. I thought,
or have we?
I thought we might have, but you know what? Maybe you're right. Well, maybe I'll make up for it. I'll do
you
some more.
Well, we have to dig this up because he's got plenty of material for us.
Yeah, no, you're right. So we'll pull some from the vault. Don't worry, Jim. If you're listening, we're gonna get you on again. Okay. So that was a lot of fun, Patrick. Like I enjoyed that. And when you get Kramer, both Kramers, in fact, how much fun can it be? It's just it's a huge cornucopia of different clips that you can choose from.
Oh, you know what? And I've never looked at Scotch the same since then. It's one of my favorites. Anyway.
Okay. Let's move on to the After Hours. This was a difficult one to choose, and ultimately we went with After Hours with Chase Taylor, Waiting Like a Jack Pine, episode 23 from April 12th, 2019. I don't know. I think it was just kind of the Canadians and us. We feel like anything that has a Jack Pine in it, we have to go with.
All right, let's have a listen.
Okay. Okay, thanks for sticking around. We got to talk to Chase about some a little more detail about some things that he's talking about. And Chase, I'm going to start. It's Kevin. I have a client, a big client, a smart client that he's a big believer in, or not believer, but a big kind of China follower. And one day he sent me this email and he said, you got to read this guy. This guy understands China. He gets it. And do you know whose letter he sent me? He sent me yours. So I just kind of wanted I'd like to talk a little bit about your theories about China and what, in terms of the game that they're playing, in terms of, I guess, from a technological point, the fact that we're not in a trade war in the regular sense of the idea, but more in a technological war. So why don't you kind of just go down that road and let's have a discussion about that, because I'm sure our listeners would love to hear it.
Yeah, absolutely. And I think that, everyone pays attention to the trade war and everyone's reading every last word to try and figure out how many soybeans China's going to buy. And I don't pay much attention to that. I know when it comes to actual trade, they'll figure something out. They'll sign it. I just don't think it's going to be that big a deal. But I do think we are in a Cold War with China that's mostly going to revolve around technology. I think the only chance China really has to escape the middle income trap, kind of before their demographics really set in, is to have some major advances in their technology and innovation and being able to domestically produce a lot of more high value added products. They kind of run out of room to just build more and more stuff. There's only so many railways and high rises and stuff that you can build. So granted, they've kind of exported that excess capacity with the Belt and Road Initiative, which the U.S. kind of seemed like finally figured out that if we try to compete with them on that, it could slow down their ability to hide their excess capacity in the rest of the world. But them trying to fight us on technology is going to be a really big deal for the U.S. and for China. There's a lot of major advancements that are kind of on the cusp in technology, and who gets that stuff right is going to really be able to put themselves in a great position. It's something that I find interesting. I know you've talked about a lot, Kev, is the 2021 100-year anniversary and the next Party Congress in 2022 in China, wanting to go into that looking and feeling good. So I'm sure they will pump some stimulus. But in my opinion, they've reached a point where they're kind of pushing on a string with stimulus, and it would take so much stimulus for them to really pump their economy that I personally don't think they're going to go as hard on that as a lot of people do. And if they do, pump major stimulus, I think that would be them kind of trapping themselves into being a middle income country that kind of just fades into a lost decade the way Japan did, personally.
Wow, I love what he has to say, Kev. That's definitely I share a lot of your views on that in terms of the fact that there's only so much China can do on the short term, and I think that this is all an overreaction that we've seen especially even today when we see the first reactions off of the China data. There's just, in my mind, this is the probability that this is sustainable is just not high. I think that this is just a short-term overshoot that will mean revert to a downtrend that they're in.
Yeah, Chase, you got to remember one thing about Patrick. He's always bearish. He's just always trying to figure out ways that's going to do.
He's got a little bit of that financial justice warrior.
Yeah. So, Chase, what does this mean for investors going forward? Like, how do you position yourself if you assume that the Cold War between the U.S. and China is going to get worse going, in the years to come? And am I reading you right that that's what you assume, that this Cold War will increase?
Yeah, absolutely. I think you'll see more and more competition, whether it's with the Belt and Road, with the U.S. trying to kind of compete on that level in some way, or at least trying to stifle them. You'll see, what we've been witnessing with the Huawei kind of aspect of this whole thing. I expect to see more kind of conflicts of that nature, where if China takes the lead in a given area of technology, I expect to see, a significant response to that. But it's important to keep an eye on who is winning from the actual technology standpoint. And when it comes to the trade deal, like, what's going to be super important to look at is not how many soybeans they buy, but what do they actually give up in any way, shape, or form that would limit their ability to win the tech war. And I kind of expect that to be very little, or if there is anything there, for it to have weak enforcement. So getting to the bottom of that when that does come out is going to be important. And then, trying to dig in and figure out who is actually innovating well as we move forward is going to be important. The U.S. has done a lot in the last couple of years to beef up their ability to defend from China coming in and grabbing technology, whether it's through investments or, in Silicon Valley, or just actually stealing data. They have 350,000 college students in America, and a lot of them are STEM students. And a lot of the way those schools go about accepting students is changing because of the government. So kind of just keeping an eye on the way all that's playing out is going to be very important. But from like a bigger macro perspective, I think what's important is China. To me, China's at a really pivotal part where they're about to go crazy with stimulus and ruin their ability to escape the middle income trap, or they're going to keep actually reforming structurally and stimulate, but on a smaller cyclical level. And which of those they choose, to me, is gonna tell you everything you need to know. I think Xi would be happy to actually reform, but I think a lot of the powerful people in the country that have gotten rich and powerful on building high rises and trains, they're not going to give up easily on staying rich by giving that up so that they can build more microchips or whatever.
But how will, like, the actual reform isn't too often their idea of competing on technology, on technology basis? Isn't that just, like, as you mentioned, just stealing? So are you arguing so you've given kind of two choices, one being they continue to try to steal and go up the value chain on terms of technology, at which point the U.S. is pushing back hard, or they go back to the old, just kind of build, bridges to nowhere and empty skyscrapers and stuff like that. Right. Isn't there got to be a third option, or is there not? Is that all that we're faced with? Is those two different choices?
I think they're going to have to lean one way or the other, and to me it'll be obvious which way they go. One of the best ways to watch this is to watch real estate. They've tried to put in some reforms and some caps to keep real estate from becoming a bigger bubble, and they've held more firm on that than I expected them to. But so if they loosen all those real estate reforms back up and just let the bubble go crazy, then in my opinion, they're giving up on trying to really transition their economy, and they're just going back to the old school. But if they go back to the old school, then they're destined to be another Soviet Union or Japan, in my opinion.
What do you think about the Kyle Bass theory that they're, one kind of bad, that their foreign exchange reserves are dwindling down and they're about to, be gone, and they're going to have to be forced to revalue their currency at 50% haircut from here?
Yeah, I think they need to devalue, but I honestly don't expect it, especially anytime soon. And, the reserve numbers have been doing better lately. I think what this is going to come down to is who's right between Kyle and Luke Gromen, because I know Luke thinks eventually they're going to be able to buy some commodities like oil in RMB, which will ease up, that current account pressure. So if they could ever convince Saudi Arabia or somebody to sell them oil and take RMB, that would really give them a lot of breathing room, and then I wouldn't expect to see Kyle's theory come true, at least anytime soon.
Right.
Okay.
So, in terms of just a little bit off topic there, like in terms of macro thinkers out there, who would you say influences your work the most? Like who out there do you really love their macro narratives and the most?
So I've always been a huge fan of Kirill Sokolov. I just enjoy his thinking, and even, I mean, I disagree with him a lot, but a lot of times he just makes me look at things differently. So I respect him.
So for those who don't know, he's the writer of 13D Research. Is that correct?
Yes.
Yeah. So he's outstanding. It's a great piece that it's expensive, right? Like it's tough to get, but he's a great thinker, and it's definitely one of those things that very interesting always to read.
Yeah, anytime I can get my hands on anything he's thinking, I do it. In fact, he wrote a book back in the 80s whenever inflation was running high about how the bond market and inflation was about to end and you should buy bonds. And I mean, he crushed that,
Yeah.
So people that can see things like that coming before, and he was a very early investor in Hong Kong and China, made a ton of money doing that. So he sees the big turns, which I like studying people that see the big turns because it's probably the hardest thing to do.
Yeah.
And someone else that I appreciate a lot is a friend of mine, Alex Barrow from Macro Ops. There's so many macro people that I read their work, and it's good and interesting, but it doesn't move the needle on my own thinking. And Alex is someone that somehow always manages to change the way I see things.
Oh, so he has a website here, macro-ops.com.
Mm-hmm.
And which one's the guy that you recommend? Which guy
Alex,
is it?
Alex Barrow.
And how do the people find him? What's if you're interested in watching Alex? Is there Twitter to follow or something?
Yeah, on Twitter he's just Macro Ops, and they have a pretty decent sized team there. He does a lot of their kind of bigger picture macro writing. They have guys that do some value stuff and a little bit of everything. So sometimes it's hard to tell what work was his and what was theirs, but they write he writes a monthly that's always really good.
Oh, there you go. So when you were talking about Kirill back there and you were talking about the big moves, I couldn't help but think about the fact that Patrick and all these boys are so bearish on kind of inflation, and they always think it's going to go to zero. And I'll have to tell you something. Can we share this, Patrick, about where you were Sunday night? Can we talk about this?
Yeah,
We might as well talk about this. So Patrick got to meet his idol. And he's a really nice guy, but he Russell Napier, which is the king of deflationary, right?
Yeah,
Russell. It's easy to say he's a little bit of a deflationist. Would you not agree?
And rightfully so. He's been right, and he has a lot of reasons to be right. So,
He's a terrific guy, and I met him as well, and he's very good. He's actually Irish. I didn't realize that. I thought he was Scottish. And he's super nice Irish guy, as you'd expect. But I don't know if we need to get Patrick to kind of spend any time with any more deflationists, because it just gets Patrick all excited and makes him all the more negative. It just makes him come in and sell everything.
I will say visiting his library of mistakes is definitely on my bucket list.
Yeah, so he's what is that library? It's something about like the whole course. Well, Patrick, why don't you tell us a little bit about the course and about how it went, and kind of give us a little bit of a little synopsis there.
Oh, I mean, he brought in a bunch of great speakers and teachers that covered everything from historical valuations in the stock markets and what's one of the best ways to actually measure whether or not a market is overvalued or undervalued, and more importantly, what causes it to mean revert. And then he brought in John Greenwood, which is the chief economist at Invesco, and he did a phenomenal job talking about money supply and the impact on the business cycle and all this. It was really good. They got into behavior finance and forecasting in the next 10 years. So lots of really interesting things I'm going to be talking about in the future shows.
So it was just basically all you guys talking about how there's going to be no velocity and there's no money supply growth, so we're going to collapse.
Yeah, but I mean, a guy like,
right?
well, listen, a guy like Greenwood was basically talking about the fact that he thinks we're only mid-cycle, not late cycle, and he actually was forecasting 5% inflation next couple of years. He was actually in a completely different camp than Russell. It's interesting that
Hey Patrick, did you throw up in your mouth? When
yeah,
you
I
heard
did
that?
a little bit. Like I couldn't believe what I was hearing. This this mid-cycle shit. And but anyway, I mean, it's certainly important to always take into consideration, one of the rationale. In fact, I reached out to him afterwards to see, if we can get more out of them in there. But I mean, really, the one thing I think I took away from it was they really go back to studying the rate of the change in money supply and as a major influence to inflation expectations, and that no matter how much you can play this commodity cycles and all this stuff, that money supply in the end tells you everything you need to know about the bigger picture trend of inflation expectations. And really the conclusion I took away from it was that there needs to be something introduced that somehow changes the trends in money supply for there to be real inflation. It's not that it can't be inflation, but under the current system and the current trends, it's not a risk, is what I got from it.
Well, I'll tell you one thing. I think that he's correct. The money supply has to pick up, but I think that's a backward-looking indicator, and that
it's not a forecaster forward. That's for sure.
No, but I think that when you're looking at commodities, they're already telling you that money supply is picking up. So I think that what you're going to find is the money supply is going to follow what commodities and what risk assets.
Yeah, but I mean,
have
there's
done.
going to be bumps on the up. But is it the sustainable one? I mean, look, if oil is heading to $200 a barrel, then that would I would understand your point. But I mean, if we're now going to approach the top end of the range, then there's going to be a short-term surge in inflation, and then it's just going to the rate of change of inflation will wean right off, and then we're going to get back to where we started. And it was just a 6-month hiccup.
So, Chase, I got to tell you why Patrick was having trouble swallowing your inflation kind of forecast. Because we all know that oil's going right back down to 35 or 25 in the next little while. So, Chase, what do you think the chances, tell me where you think oil will be 6 months from now? And I understand you're not an oil, sorry, what did you say?
I said higher.
Really?
I think we're at a point in the cycle where it's just
so that
the
December swoon was just noise. It was just a liquidity event.
Yes,
and
I can explain it.
All right.
Yeah, the Saudi Arabia just absolutely flooded the U.S. with oil during that time, and it kind of for whatever reason, no one cares about global oil supplies. Everyone just cares about U.S. supplies whenever it comes to the price of WTI, and so it's pretty easy to move the price down. You flood America with oil, and everyone goes, "Oh my God, look at those, look at those inventories."
Hallelujah, Chase, you are I completely agree. People don't look at the worldwide kind of inventories. They're all focused on WTI or U.S. inventories, and they don't understand that it's a worldwide commodity. I 100% agree with you.
And the Saudis did that seemingly as a favor to Trump because he was wanting them to get the price down so much. So they chose to do it that way. And then naturally he kind of turned his back on him with the Iran sanction waivers. And then, I think that probably really upset them. And, lately they've been starving the U.S. out of oil, and it's starting to show a little bit in inventories, even though, they haven't drawn down significantly, but.
Yeah, so I have a question for you. With the recent floating of the Saudi Aramco bond, the long-term debt, they've had to release their finances, and you see that one of the things that was kind of released was the reserves or not the reserves, the production of the different fields. And a lot of people are talking about the fact that Gawar, which is the world's biggest kind of discovery of oil ever.
Kev, you got to just rewind because just start from the beginning, please.
What happened?
You chimed out. For
a
second
you
there.
dropped out.
Yeah, if you could just start for that, your little bit from the beginning there.
Okay, so where did I chime out from?
Just the sentence that you had started.
Just share your thought from the start.
Okay, you better mark down the time.
Yeah, I got it.
Okay. So, Chase, I couldn't agree with you more. And one of the things that I find extremely interesting is the fact that with Saudi Aramco recently floating that long-term debt issue, they've had to release some of their finances or some of their financials in terms of the different productions of various fields. And I noticed that some of the kind of more astute crude oil watchers have noticed that Gawar, which is one of the world's, or I guess it is the world's biggest kind of reserve, has not been kind of performing like everyone thought it had been performing. And I have a buddy that's a really smart guy that has been in the markets forever. And we were out for dinner the other day, and he told me that he's as bullish on oil as he's ever been in his life. And I was like, really? Like, I was like, wow, like, really? And he says, yeah, he says, they've just admitted to you that this whole Matt Simmons Twilight in the Desert is happening. And I said, oh, well, that's funny because all of the kind of fast money guys are short oil and they all think it's going down. And he says, all the better. And he's a long-term kind of fundamental guy. And he's convinced that oil is headed to the moon and that basically this Gawar thing is a much bigger deal than the market is realizing. What do you think, Chase? Like, have you looked into it?
I have, and I totally agree. I mean, when the biggest oil field in the world is producing a lot less than everyone thought, it's obviously a big deal. It sounds like a great time to monetize your giant state oil company, doesn't it?
Yeah, that's right. Yeah.
And and on top of that, you look at U.S. shale and how just unprofitable it is, and how fast the decline rates are moving there. Like, to me, there's a lot of different reasons to be bullish oil. I think if you look at the S curve and the middle class in Asia, where you're just having a huge explosion of people entering the middle class in Asia that are going to start consuming more energy. I just think there's drivers on the supply and the demand side for the next couple of years that, I don't know, make a lot of sense to me.
Yeah. So Chase, again, you're speaking my language. We're Canadians, so we call it the hockey stick curve. And on the demand side, if you look at kind of developing nations, and if you go back to Japan coming out of World War II, and you look at the energy use per person as they kind of got more and more wealthy, what happens is it ticks up bit by bit by bit, and then it just explodes higher. Like there's the kind of the bottom of the stick, and then it starts going straight up. Same thing happened in Korea. It started going up a bit, and then boom. So it's the exact same graph: Japan, Korea, and now we're finally entering it into China. But the thing about China is that they are so much bigger than either of those economies at that stage. So I think everyone's focused on the supply side, not thinking about the demand side and looking at that. And I agree. I think that people should be looking at oil from kind of a long-term perspective as one of the cheap assets out there. The other thing about it is
I'm just gonna take the other side of that.
Yeah, of course you are. Of course you are.
I am, but you know what though, where I'll give you guys something is that I do actually think there will be a huge oil bull market on the other side of the business cycle. But I just think that you guys are talking a story that can manifest itself over a much longer time horizon, like 3 to 5 years, and may not be as big of a deal in the next 6 months to a year. That's my opinion.
Well, Chase, I have a question for you.
I agree with that.
So I have a question for you, Chase. I saw the other day, I think it was Jared Dillian from the Dirt Nap fame talking about how some of the best performing stocks have been like sin stocks. I think it was him that was arguing this. And he said that in essence, oil stocks have become a sin stock. Right? And with the millennials, and you're kind of like one of the, I guess you're an early millennial, I would guess. But like, if you, amongst your friends, if you told them you were long like oil stocks, would that be viewed as something that's like, ooh, like when you're trying to pick some girl up, you don't want to tell her that?
I've never really thought about that. I would say the people I hang out with wouldn't look at it that way, but I think if you just did a cross section of especially the younger millennials, I do think it might fit into sort of the sin area. They've just been raised, kind of to view fossil fuels as bad no matter what. I mean, they even think nuclear is bad, which blows my mind. But
yeah, we're gonna all make it on kumbayas, and like there's gonna be, that's how we're gonna pay, like kumbayas, and Elon Musk he's gonna save the world with all of his battery power, which gets, like, interestingly enough, in California, isn't the majority of electricity created through coal burning? Am I wrong?
I have no idea.
I think it is, though. Like, it's a shocking
there is
amount.
A lot of solar and wind, I know, but
it's I don't think it's increasing all the time. But I'm going to get in trouble from all the millennials that are listening and stuff. But I really think that if you're an investor and you're thinking about the idea of energy stocks, I really believe that there's a chance that they have become the tobacco stocks of our generation. I think Jerry Dillian is on to something when he talks about that. And so everyone's wondering why they haven't rallied with oil. And I think they haven't rallied with oil because nobody wants to admit they're long.
You know what? Then I have to admit that I'm a sinner.
We know that.
One thing I will note that is super interesting in energy stocks is if you look at the ETF OIH versus XLE, it is mind blowing how beaten down like the services companies have been compared to.
So here's the OIH, and one second. And what you want me to compare that? And I compare that to which one?
To XLE. XLE.
The main.
You know what's interesting is, so I went out with dinner with these fellows that were they're older than me. They're boomers, and they're kind of wise, shrewd. I don't know how to describe them. Vancouver, kind of
pulling like on a monthly.
Yeah.
Sorry.
I'll actually just do a.
So I went out with these guys, and they're kind of shrewd operators, and they were all buying the oil service companies. So I tend to think that the smart money is buying that.
Well, you know what? I
find myself. Go ahead.
Yeah, myself am messing around with the Schlumbergers of the world. They've been the dogs, like Halliburton's and Schlumbergers. They just simply can't get. Even though surprisingly the refiners simply are dogging it too. I mean, it's really the Chevrons and Exxons that have been ripping on the upside, and a lot of these periphery ones just can't catch the bid.
Yeah, absolutely. And for me, I don't really like shale. I'm pretty bearish on shale, so I was trying to find ways to get into the oil stocks without being super exposed to shale, and that's kind of why I started looking at the services companies.
Yeah.
I mean, granted, obviously they're tied to shale in their own way, but
yeah. Well, listen,
I really like offshore.
I like your idea. I mean, that makes a lot of sense on that regard. Do you like the refiners?
Not as much as the. My favorite exposure is anything I can get offshore. So the companies that are out there, Transocean, and I do like Schlumberger as well. Like some of those services guys, I just think they're going to do better than pretty much than the refiners,
right.
and the big oil companies, because all the big companies, it seems like, have gone into the Permian and started lighting money on fire for whatever reason.
Right.
To me, that's a giant riddle, is why the majors have gone in to shale where they're not making much money or any money at all. It's weird to me.
Yeah, so here's Transocean. Yeah, the chart there. Yeah, it looks a lot like the oil service stocks. It just they haven't caught on at all.
Mm-hmm.
So Chase, what else do you like? What other kind of trade ideas are catching your eye?
So I'm a huge uranium bull and have been for like 3 years. We haven't seen much traction on that. Hopefully the Section 232 comes in soon, and that hopefully becomes a catalyst for the sector to start picking up.
This is gonna be a uranium kumbaya between the three of us here, because
yes, we all agree on this one.
Patrick, you don't like uranium.
Oh,
too,
yes,
do
I
you?
do.
God.
This is bad. This
okay,
is
so
really bad.
Chase, what's your favorite way to play it?
Everyone should definitely short sell all that.
Yeah, exactly.
What's your favorite way to play it, Chase? What are you doing? Like, how are you expressing that view?
I combine calls on Cameco with I have Energy Fuels and UR Energy are my kind of two favorite plays right now.
Yeah.
Like the frustrating thing is the fact that CCJ is like really Cameco's the only way you can really get options.
Yeah, exactly.
And the futures contract, everyone said it was a liquid, and I tried to trade it, and a liquid doesn't describe it. It doesn't move. So
Yeah.
I wish you could trade futures on it.
Yeah.
So I'll tell you something that people, for those that are more sophisticated, and before I say anything more, I just got to tell everyone that I am long this bond. It's one of my bigger holdings. Energy Fuels has a convertible, and it's only for Canadians. It's listed in Canada, but it's convertible, and so what you get is it's kind of. The bond is such a small part of the market capitalization of the whole stock that it ends up being that there's the credit portion of it is going to be good. It's a 2020 and it's a convertible. And let me just pull up the details. It's 8.5 coupon.
So this is the convertible for the Energy Fuels, which is that UUUU?
Yeah, that's correct. It's EFR in Canada because we have a different symbol. But it's an 8.5 coupon in December 31st, 2020. And it's, I think it's one of the better ways to play it because to me, I think from the credit portion standpoint, it's money good. And then what you get is the opportunity if something really good happens to take advantage of it. So it's convertible at a price of, where are we here? I'm just trying to kind of.
We're at 439 right now on the stock.
Right. And it's convertible at 415. So it's at the money.
Yeah.
So to me, I just think it's super illiquid. So don't run out and kind of just pay up for it. But it's
don't
one
go
of those
Scorpio
things,
on it.
Yeah, but it's one of those things that if you're looking for, and if you're sophisticated enough to kind of trade a convertible bond, you should have a look at it because it's, on down days, it's something that you should be looking at buying because I think it's a great purchase.
Kind of.
So what else do you like?
Yeah,
it is had a couple ugly couple of days, but it's that's just that's the way that the thing trades. It's very liquid. Yeah. It doesn't it makes no rhyme or reason to what the movements, and you guys can put all your squiggles on it what you want. It just, if someone comes in and sells it, it goes down a lot, and someone comes in and buys it. It's going to be one of those things that it just resolves itself hopefully higher. One of the things that a lot of people play is the U, which is the Uranium Participation Unit. Yeah. Which is an ETF, and you can buy that thing. And the interesting thing about buying it's a closed-end fund on uranium, is that you're buying a commodity that is trading below the cost of production. And not only that, the spot is trading significantly below where long-term contracts are being executed.
So it's you don't have that burn.
Yeah, so hopefully it should be decaying upwards, but it doesn't look like it is lately. And as Chase noted, it's been kind of a frustrated. It just hasn't gone. So, just for those who don't know, 232 is what a bill proposed by EFR actually, or Energy Fuels, for the President Trump to stop selling all of their excess uranium and make sure that they're buying a certain amount from local domestic suppliers. Is that correct? Chase, are you familiar with the specifics of the bill?
I think it's just going to be another one of those. I don't think they really spell out the prescription on what to do. I think that's kind of still up in the air. And I know a lot of people are actually worried about what they'll do with that, whether it's quotas or something different. But it's one of those, is it a threat to national security questions? And the way I see it, if automobiles are, then surely the fact that Russia controls so much of our uranium needs, I would say, is probably a threat to national security. So I would assume it's going to go through. But I don't think anyone knows what the administration would do about it if it does go through.
Right. So for those who
for
those who haven't followed it, is that for the longest time, there was all these nuclear warheads that were getting dismantled, and then they were getting sold off into the market. And that's part of the reason that uranium has been in such a terrible bear market, is that all of that fuel had been kind of converted from nuclear warheads into fuel for uranium reactors. And in doing so, it's made it so that there's not that many mines out there, and that if all of a sudden Russia could actually controls the supply of uranium between, I believe, Cameco and Russia, I think that's the majority, even more than majority of the supply. And given how the United States has been treating Canada lately, you can't even rely on us. And so I think the Americans are kind of waking up to the fact that this isn't a good idea, and that they should kind of secure their own nuclear stockpile. And so that's one of the things about EFR, Energy Fuels, that's so attractive, is that it's one of the few kind of American projects. Is that, like, if I got it right, like, is that basically it?
Yeah,
Chase?
exactly. And that's why, like, UR Energy and Energy Fuels are two of the, they produce in the United States, and it's 20% of the U.S. grid is nuclear power, and yet we produce almost no uranium.
Wow.
So clearly an issue. So the U.S. producers should, theoretically get a nice boost if there is some sort of price control put on, or production control.
Yeah.
All right.
Okay,
And
so what
listen-
else do you like? Do you have? Oh, sorry. Go ahead, Pat.
No, I
Patrick.
was just going to ask you, Chase. Is there a fun story behind the name of your newsletter, the Pine Cone, or is it just a name that you just liked?
So no, it actually goes back to Mark Spitznagel wrote a book called The Tao of Capital. And in that book, he uses a lot of metaphors to talk about the economy, and whether it's martial arts or war. One of them, he talks about coniferous forests, and he talks about the strategy of the pine cone, and it gets really deep into how pine cones won't open if it's wet outside because they can't spread their seeds. If it's not windy, they can't spread their seeds. They won't open. Some pine cones, like the jack pine, it actually won't even open its pine cones unless it's in a forest fire where it's like 2,000 degrees. And the reason it won't do that is they compete against deciduous trees for territory, essentially. So they kind of sit back and wait for a major disaster that kills their competitors, and then they go in and spread and take their territory over. And the book goes on with different levels of strategy that pine trees or pine cones kind of seemingly implement. Obviously they don't. Actually, they're not thinking about it, but I just found the strategy in a pine cone to be just really useful as a way to think about markets.
Well, see, I'm glad I asked this question because this is fascinating to me.
It's great. I had no idea.
This.
Yeah, so I wrote a free letter for a long time called the White Mountain Letter. And every one of those letters, I would talk about a different pine tree and get into what made it significant in these different kind of analogous ways. So yeah, those are actually, I find them interesting.
So Chase, I didn't know you're a big tree guy. What's your favorite pine tree then? You better say the white pine, because that's what most of Canada is filled with.
Douglas fir. So what's the story there?
Indeed. So I wrote about this a little bit. It kind of does something called morphological plasticity.
Yeah.
And I'm sure you guys have heard of, like neurological plasticity is kind of the ability to adapt. And you think about trees and evolution, you think they probably adapt over, millions of years, and that's true. But like a Douglas fir can actually adapt almost near real time to its environment. There's some of them that grow almost as like shrubs, in like more desert-like areas, and there's some that grow really, really high on the coast of Washington. So their ability to do that, I found to be really interesting. And I kind of wrote about how, as a trader, you have to have that same sort of plasticity.
That's awesome.
That's terrific. Have you gone to the redwoods, by the way, while we're talking trees, or the sequoia?
Yeah. So I live in Southern California now, but I lived in Northern California for years and got to spend some time, especially the coastal redwoods, the Avenue of the Giants, which has a lot of just massive trees. So and I've written about them as well. They're pretty crazy.
I took my family up there, and it was one of the greatest trips we've ever done. Like, it's outstanding, and I would highly recommend it. And actually, my wife's going back, and she's going to go to the sequoia, because the sequoia is a little more inland. The redwoods go right on the coast. And have I got that right? Yeah, I think I've got that right. The sequoia, the redwoods are more on the coast, and the sequoias are more inland. So she's going to go look at the sequoias. And I believe the sequoia is the biggest tree, but the redwood is the tallest. Is that right? Like you seem to be much more.
Right, yeah.
You sound like a much more of a tree expert. But till you go there and get an idea of the size, it's mind blowing. And then the fact that they went and just cleaned all those trees out. And if you're in San Francisco, you basically have to drive 5 hours north. You have to drive far enough that they couldn't haul the logs back. Like that was it, because these trees are like 300, 400, 500 years old, or even older, I believe, at times. So you have to go kind of so far north that they wasn't economical for them to kind of cut them down and bring them into San Francisco. So it's just fascinating.
Yeah, and the Muir Woods actually is right outside of San Francisco, named after your namesake there, John Muir. And you can see some redwoods that are actually kind of close. Pretty small forest, but it's a really cool place.
Yeah, I was joking with Brent Johnson the other day because someone asked the favorite underrated movies, and he said Spy Game. And I told him that was the second coolest Muir out there, and that was because Nathan Muir was the character, Robert Redford's character in Spy Game. And I said, and the number one is, and I said, it's not me, it's John Muir. And so I can always tell somebody that's grown up out west because some people have trouble with my name, but for those that have kind of been around San Francisco, they all know John Muir because of Muir Woods, and it's all of a sudden. Exactly. They asked me if I'm related to him, and unfortunately, Muir is not that uncommon a name in Scotland, even though it's uncommon.
Yeah, and speaking of Brent, Brent's a good friend of mine, and he, you asked about macro thinkers earlier, and I think everyone thinks of him as a gold guy, but I really think that Brent is a really good macro thinker and a very original macro thinker.
Yeah, he was one of the first guests on the Market Huddle. And I had a chance to meet him out when I was in San Francisco a couple of times. So out in Vancouver. So he's a super guy. I'll vouch for that.
Super nice guy. Although we are kind of worried as gold bulls, or not worried. We're kind of excited about the fact that he's closed his gold fund.
He's called the bottom on gold.
He's called the bottom on gold. He's closed his gold fund and given up on it. So we're kind of as long-suffering gold bulls, we kind of view that as a positive development.
Yeah,
Brent,
if Eric Townsend gets long oil, I'm done.
Okay, Patrick will quietly be just no comment to that thing, but and he didn't laugh, but I did. Okay, that's a great line, buddy. Okay, well, Chase, thanks for spending some time with us. Why don't you just kind of in following up, why don't we tell everyone one last time where they can find you? Give us the Twitter handle and the website.
Yep. Twitter handle is @PineConeMacro, and the website is pineconemacro.com. And then if anyone wants to read a letter, my weekly is called The Cascade, and there's a Pinecone Macro research tab on the site. That's how you can get to that to sign up for it.
Well, that's terrific. Thanks a lot. It was great having you on.
Thanks a lot, Chase.
Yeah. Pleasure, guys. Thanks for having me on.
Oh, you know what? That was classic. And listen, all of our listeners, just so they know, listen, thanks for, this summer special. We just put it together, patched it together because Kevin is on vacation. And I am also going to take some time off. So we needed to put something together to keep you guys entertained, all of our listeners entertained while we're enjoying a couple weeks off. And Kev, now you have also something planned for next week. Why don't you let our listeners know what's going on?
Right. So I taped something for next week. It's definitely not Market Huddle, lots of beer kind of stuff. It's a little more serious, but I think it's really important. It's a kind of an interview with one of my pals, and I think it'll be something that let's just say that hopefully opens your mind about the way to think about markets, and I'm looking forward to it because I think it's a really great full 2 hours about talking about markets in a different way.
All right. Well, listen, all of our listeners will hear that next week. And then we'll go back to the normal schedule in the first week of September.
Yeah, and we actually have a great September and October lined up. It's terrific. We have a lot of terrific guests that are going to surprise you and a lot of new beers, and it's going to be a lot of fun.
And also in September is our Market Huddle meetup. We're getting into the habit of doing this more often, which is great. You know what? It's so much fun meeting our listeners, right? Because all walks of life, different personalities, but they all come together, and it was such a great time in the last couple of meetups we had. No?
Yeah, no, it's been a lot of fun. We got to try to find some new spots to do it. We're going to do it in Toronto next time. But then you know what, Patrick? We should figure something out. We should pick something nice, like what, Bahamas? Maybe we should have a Market Huddle meet on Bahamas.
Yeah, for the whole 2-3 people that will show up. But anyway,
doesn't matter.
It's a reason to go.
It's a reason to go to Bahamas. Like it'll be the Mr. Taxman won't mind. Seriously, it's in Toronto. What's the date, Patrick? I've already forgotten.
It's Friday, September 20th. And it's going to be at 7 p.m. So there's the Money Show going on in Toronto that Friday and Saturday. So after the Money Show's wrapped up, we're all going to meet up at the Rec Room, which is at 255 Bremer Boulevard in Toronto. Did I pronounce that right?
I have no idea.
I think it's Bremner.
Bremner Boulevard. So it's going to be a great time. Lena's going to show up. So is Chai
right.
Girl.
That's right. Tracy's going to be there. It's going to be a lot of fun.
Yeah, it's going to be great. So anyone who can make it out, you don't need to RSVP. Just show up. It's all
just
you
show
have
up.
to,
It's going to be
just
fun.
show up. And all you have to do is buy us a beer. No, just kidding.
No.
But no, you can show up. It'll be a great time. Love meeting all of our listeners. It's going to be a great time.
Okay, so a big thanks again to our sponsor, Andy. You know who you are. We appreciate the couple of cases of beer. It's always great. And to Kuppy, and we look forward to Kuppy's Corner every last Friday of the month. I'm excited. We came up with that idea, and I'm jazzed. I don't know about you, Patrick. I think it's a terrific idea. It's actually Patrick's idea. Yeah, I love it. Kuppy's Corner with a K, though.
Yeah. By the way, just quickly, where can people find you or follow you?
I'm at Kevin Muir or themacrotourist.com. And how about you, Patrick?
Yeah, you can follow me at Patrick Ceresna on Twitter, or you can go to bigpicturetrading.com. And yeah, there we go. It was a good episode, wasn't it?
It was good. Now let's say, Lena, hop on. What do you think of our breakfast wheat?
I think I would give it like a 7.2.
Oh, really?
Yeah.
What is with you guys?
Look, you busted my balls for giving Wayne Gretzky's beer. What did I say? 7.5?
Like 7.5? Like, yeah. You
Yeah,
guys have no taste in beer. Okay, so you obviously didn't like the breakfast wheat. What was wrong with Alina?
I don't know. Like I said before, it tasted like it was a segue to a sour beer.
Oh, see, I didn't find that at all. Patrick, what do you think?
Well, first of all, right on the side of the can, the most important thing, it says there, allergen alert for wheat. And so,
it's going to get me gassy?
Yeah, so this immediately is, that loses score, because any beer that can cause an allergy is, no, just kidding. But listen, I want to make something very clear. When I give a 7.5, I actually still think it's a good beer.
Okay.
I do not think.
I hear what you're saying. Like a bad beer is a 5. A bad beer is 5
or less. And
okay, so what do you think this is, Patrick?
7.4.
Okay, so you think it's slightly worse than the last one. I definitely agree with you that the last one was better. I gave the last one an 8.9. I am going to give this thing 7.9. I don't like it. I like it slightly better than you guys. I think it's a good, solid beer. I don't know, the bananas, I couldn't get around that when they told me it tasted like bananas. I kept thinking about it. So, Lena, I see that you were on, what is it, Love Sack?
Oh, yeah, lovesack.com when you go to Kuppy.
Yeah. I had no idea. Did you know about this Love Sack?
Oh, I looked it up. I was like, what is this about? At first, I thought he was talking about some, adult toy store. I'm like, what are we talking about? Love Sack? What is this?
Of course your mind went there, Lena.
And then when I went, and then when you were talking about beanbag chairs, beanbag chairs at an adult toy
Yeah, no, it's crazy.
But I looked it up. It looks so comfy. It looks like,
So, here on the website, I've got, these bean chairs. Is those what you were
look on one
looking
of the pictures.
Yeah.
People are laying down. Look.
The big one, $1,300, showing an Eskimo swirl fur. Super sack, movie sack, pillow sack. The big one bundle.
Where do you want me to go?
I don't know. But look at this picture of this woman and her dog in this gigantic beanbag chair that's probably soft and plush. It's like a
it's
perfect
so comfortable
time for
looking.
a nap.
This is true disruption.
No,
I'm going to sell lazy chair now.
Yeah, so I love
Lazy
the
boy.
millennials. I do. I really do. I think they're a great generation. But if there's a single Gen X that has ever bought one of these love sacks, I'd like to hear about them.
Oh, Patrick, you gotta put up that picture I sent you about you guys hating the millennials.
What?
Oh, yeah, I did. Lena sent us a very good picture.
Oh my God! Hold on a second.
Patrick, your problem is
you didn't prep me for this.
I know. So let me take care of it because Patrick's terrible at the computer, and he's here. Let me send it to you because Patrick doesn't know how to do WhatsApp on his computer. So I'll send it to you.
Oh, okay. So you sent it WhatsApp. All right, that's fine. Send me an email.
Okay. And you know what, Lena? I'm sympathetic to you on this. Whenever a Gen X person says that they think millennials are stupid looking. It's a picture of Gen X people doing the craziest, stupidest haircuts. What is that? The mullet.
All right.
Who
here
came
we
up
go.
with that haircut? It is. I
The
do not
mullet?
understand.
There we go.
I don't know.
Everyone see this on the screen now? There we go.
Yeah.
The whole like business in the front, party in the back just doesn't work
Yeah.
out because
You know what?
The whole thing.
There's a picture that I will never show. That of
You with a mullet?
You can't mention
Oh.
it and not show it.
Oh yeah.
I will
so
not. I will not.
That's
Okay,
just
listen,
begging
Lena. You
for
know
us
what? That's
to-
going to be our goal is to talk to Mrs. Big Picture Trading and figure out how to get the mullet.
Yeah, for
shot.
sure. I will definitely do it.
I will send you one. One time we were I was getting registered at for my OSC, my Ontario Securities Commission, and I was pulling out my file, and I pulled out this file from when I was like 23 years old, and I had hair then, and I looked like I don't know, like a mobster, one of those mobster guys. And they were all making fun of me. Oh, you know what we'll do? I'll post it because they were like, "Oh my God, look at you! You used to be like a mobster and one of those. You know, remember back in the 20s, like a Godfather kind of like mobster. That's what I looked like, and it was funny because it was black and white as well. So it like one of the guys said like, "How old are you actually?" Because this looks like it was from 1920. Oh well. Anyways, you know, I'll tell you one last thing about Gen X versus Millennials. And I'm going to give you a little piece of advice for the Millennials. If a Gen X is ever giving you a hard time, saying that your generation is dumb, tell them to Google Mick Jagger, David Bowie dancing in the streets, and it'll shut up any Gen X that you've ever seen.
Mick Jagger and David Bowie?
Oh, you haven't seen it, Lena?
I don't think so.
It is so embarrassing.
Oh.
Like as a Gen X, I just cringe and I just want to like roll into a little cubby and die when I see that video.
I at first I thought it was a joke, and then I found out they were really doing it for real.
Patrick, you don't remember that
Wait,
video?
this is a
I
real
do.
music video?
Yeah.
Lena, look it up right
I'm
now.
watching it right now.
So Lena, you know what? Make sure you put it on the video on the email. It's so embarrassing. So that was actually the guy that I work with, Ryan. He's kind of in between Gen X and millennial. Like he's, I don't know, an elder millennial, I think they're called.
Yeah.
And he always gives me a hard time. He always says, "Listen, you can't say anything about millennials because look at this video you guys created." It's so bad, eh? Okay. Well,
All right.
anyways, have a great
Listen,
weekend,
yeah,
everyone.
no. Okay, listen. By the way, just so everyone knows, we did actually record this on August 19th, even though we're labeled it the 23rd. So the charts
You're
that
telling
I was
everyone
showing
now
were,
at the end.
Yeah, no, but that's okay.
Really smart,
Just to
Patrick.
see if
Because-
anybody's listening
because
all the way to
the
now.
people that didn't really matter to already left. The people that stayed need to know. But
know.
with
Poor
that
Kuppy said something
you're
about it,
leaving
like
on vacation. You're leaving
I'm
on
leaving
vacation.
on vacation. That's correct.
Right,
Yeah, I
and I'm going to be gone as well. But listen, we'll be back in September. We're going to play that special thing, and we got a great back half of the year.
Lineup.
set
I'm
of
actually really
episodes lined
jazzed.
up.
Like it's really good.
What is this
Like the
term,
lineup?
jazz?
Jazz? You don't know that?
No, I understand, but it's a very old
It's
school
very
term.
80s.
Yeah, it goes with the picture.
Okay. Well, we have some big name.
That's why he
names
used the
going.
word, because he was inspired by the pictures.
Yeah.
I love, by the way, your Orlando Bloom picture. I was a macro tourist right there on vacation.
For sure. I actually still worry about that. We went a little too far with it. We'll see how it
You
goes.
probably did.
I think this.
We'll probably get
I
some
don't think
complaints.
this is too far.
The 7 ladies that listen to us will be very excited about it, though.
Yeah.
There might be 11.
I don't.
Maybe
I
8.
that's why I was just like, what's so offensive about it? I'm looking at it right now. It's fine. If anything, you may gain more female listeners / viewers.
We might get it up to 22.
That's right.
That's right.
All
So
right.
have a great summer, guys.
Yeah. Listen, enjoy the rest of your little trip.
And
out,
anybody that's
to
stuck
San
going,
Diego.
make sure you stick around next week because I really think that you're going to enjoy it. It's a really outside the box kind of thinking from a really smart fellow, and I think you're going to really like the interview that I did.
All right. And
Okay.
otherwise, Lena, thanks for everything, and we'll Kev, enjoy your vacation, and we'll reconvene back in September. Cheers,
Take
guys.
care, guys. Bye bye.